AM 1220 KDOW and Money 2.0 present The Real Estate Report with Tony Mendez and Gordon Hines. Bay Area real estate and mortgage experts with over 25 years in the business. Now, with an in-depth look at this week's local and national real estate news and what it means for you. Your hosts, Tony Mendez and Gordon Hines.
Welcome back to the Real Estate Report. I'm Tony Mendez.
And I'm Gordon Hines.
And we truly mean that. Welcome back, for especially all the repeat listeners. And we've been on the air for 6 years now, Gordon.
Time is clocking.
Time is clocking.
What else do they do?
It ticks. Okay. Let's just use what everybody knows. It is call-in show 800-516-1220, 800-516-1220. We hope to be your best second opinion in real estate, if not your best first. Gordon's been in the business for many, many years. He's done everything from being a realtor to a mortgage broker to flipping homes or reselling homes, he likes to say, property management and construction and so on. And I've been in financing for almost 20 years now. And this is a perfect mix of two of the best people in real estate, in my opinion. It can help you with those second opinions. And we do transactions. That's what we do. You can go to BayAreaLoanSource.com, BayAreaLoanSource.com to find out more about what we do. We
help people close deals. That's what we do. We speak with a lot of realtors. We get a lot of tough transactions to do. We get some easy ones also. But we get people who call, and one of the greatest compliments I get is, Mr. Hines, whatever you tell me to do, I'm going to do. That's a great confidence, I think. That means that I'm doing a good job because I know what I'm talking about. I'm going to give you advice that's based upon your best efforts, not mine. I'm not in it for profit. Of course, I get compensated. But at the end of the day, I'm in to give good service and make sure you come back as repeat customers.
It's a tough business out there for the mortgage officers, loan officers, even large companies. Capital One, for example, they're exiting the mortgage business, and they're going to cut 1,100 jobs. They just say they can't be competitive anymore. Do you see a little bit more of that happening, Gordon? As this paint a little bigger picture for everybody. During the .com and the big rush to real estate in 2007, the majority of transactions were done by brokers. Those are people who, like Gordon, who use multiple lenders as their sources for lending on what they call a wholesale level. But in the bank's portion of all of the transactions were smaller. Then the mortgage crisis hit, and everybody went back to banking, back to the big lenders, the Bank of Americas, the Wells Fargos, the Chases, and so on. And now that's flipping back again. A lot of it has to do with service. A lot of it has to do with rate. A lot of it has to do with what I call the grass is greener on the other side. And it's now becoming a broker's market again because of the amount of products that we use, to be quite honest, and the amount of expertise that actually stays in the business. I bet you Capital One would have stayed in business if they actually had, and I'm not trying to offend anyone out there that worked for them or works for them, but I bet you if they had better and higher quality people, more educated, they would have stayed in business longer. What do you think? And it's a problem that a lot of large banks have.
Well, I just happen to know a little bit about Capital One from my experience in working with Capital One over the past few years. Capital One was in the credit card business. They ended up buying the block of loan business from another company.
I think ING too,
and
as well.
Then what happens is they find out that, everything is not the same. And I think they make a lot of bad decisions. The people that they bring on is not the best. And over time, they decided, hey, we made a bad decision. And one, they either sell off that book of business to another competitor, or they simply close their shop and get out of the business. And that's what I think has happened. They were traditionally the credit card. They do really great credit card businesses. Hey, they go over to the loans, and then it's a total different business. It's a book of business, a different mentality of a customer. And the two are not, even though both are financial efforts, they're not on the same page. And I think that's where a lot of companies make mistakes, and that's how they end up going down the wrong path, and if sooner or later they either sell it off or close it up.
And they were struggling to boost loan growth. They said that the rate environment and the marketplace do not allow us to be both competitive and profitable. I can't imagine that. The whole profitable thing. It is profitable to be in the mortgage business. They were doing something else wrong. You're also welcome to call the show 800-516-1220, 800-516-1220. So we're trying to paint a picture of how brokers fit into the real estate market, Gordon. I think maybe that's a good theme for the day. And there's a lot of other things we can talk about as well. Is it time to gut the mortgage deduction or mortgage interest deduction? Realty groups in California fear that home buying in California is going to be hit, as well as home prices, because of the tax reform. Which metro areas can be hit hardest by the latest tax plan and capping the mortgage interest deduction? There's other stories. Here's an interesting story about real estate agents and a new tech firm. I can't remember the name of it. They are trying to protect real estate agents from opiate addicts. That's a really interesting. Let's talk about that real quick. And I'm sorry to laugh. It isn't fun. You know that about 50% of realtors actually fear for their lives when they go to an open house if they're alone, because a lot of there's a new thing where addicts are posing as home buyers and they go and raid the house when they go and look at this open house. Gordon.
Well, as you know, we a lot of our clients are real estate agents, and of course, a lot of the real estate agents are women, and even men. And we always tell people, anytime you're in a house by yourself, security is always a concern. There are a lot of things that a lot of companies do to teach personal safety, personal security. That's one of the best fighters for personal security has been the cell phone. It really keeps people close to home. The quick dial 911. If you don't feel comfortable, step out the house. A lot of things you can do to kind of protect yourself in open houses. I've been to an open house the other day, and it was a young woman, very attractive sales agent sitting in the front, and it was a guy. I assume that was her boyfriend, just in the backyard, just walking around like he was on patrol, which was actually was a good thing. I didn't feel intimidated, but I thought it was a good thing because here, this beautiful woman here in this house by herself. So you have to take your personal safety as top priority, and you just have to make those type of decisions when you go in open houses as a person, either female or male.
The company is called Cogent, and they have researched this. They say about 5% of agents have actually have reported being attacked on the job, while more than half regularly carry some sort of weapon for self-defense, the most popular being pepper spray, even firearms and tasers. It's kind of crazy. You just have to be careful if you're a realtor out there. And but this new high-tech gadget that they have is kind of like what the police use, and it can actually. You can put in, if you're making an appointment, for example, you can put in the person's name, social, or maybe even address, and it'll tell you if they have any criminal records. And then maybe you go, oh, I'm not going to do an appointment, or maybe you do bring somebody else with you. Is that borderline discrimination going at some point?
Honestly speaking, I don't think anything is borderline anything when it comes to your personal safety. At the end of the day, you can apologize for it if you're wrong, if you made a bad decision or impression. I remember one of the, I like to tell this story. I had bought this building, and there was a tenant upstairs. The first time I met him, he was coming upstairs, and I was coming downstairs. I ran into this gentleman. He was about 6'9". Guy looked massive, intimidating. He was one of the nicest people you ever wanted to meet, but based upon his appearance, it was kind of intimidating. So not all that meets the eye is what it actually is, but I tell people all the time, at the end of the day, if it's a safety issue, you always better be apologizing than to be sorry for what you did.
I agree with that. I think something like this could eventually get phased into the National Association of Realtors and all of those guidelines that they have to follow. Freddie Mac Weekly Survey has 30-year fixed at 3.9%. Great rates out there. Expect it to go up a little bit. Again, I was wrong. I'm not going to predict. You know what? I'm not going to predict. How about that? It's 3.9%, according to Freddie Mac Weekly Survey, 15-year.
Well, that's what I always preach. I'm not into the prediction. I tell people if I was a prediction, I had a crystal ball, I'd be rich. I wouldn't be on the show, right? We just got to go with the trends. We got to go with what the trends are, what the market is leading to. There's economic news that come out daily, weekly, and we just have to kind of, if you are going to predict, you got to refine your predictions, because what's good today might necessarily be good tomorrow as far as a prediction is concerned.
Well, everybody's concerned about this mortgage deduction, interest deduction cap, going from $1 million for a couple down to $500,000, and how that's going to affect the market. What is your opinion on that?
One of the things that I get disappointed in government for is the lack of use of technology. So, for example, the standard conforming loan rate nationwide is $424,100. So, a friend of mine who lives in Alabama, he can get a conforming loan for $424,100, but here in the Bay Area, a loan for $424,100 is conforming,
But it require probably $200,000 or $300,000 or $400,000 down.
Yeah, but it's not realistic for our area. So I want to know why can't the federal government have, like everything else, have these numbers skewed to either states, zip codes, neighbors, whatever trend it is
Whatever it
that
takes
makes sense.
to conform to that neighborhood,
That makes
as
the most
opposed
amount
to
of sense.
yeah,
So we're talking capping of the interest rate.
interest deduction.
Interest
yeah.
deduction for California, $500,000 is a drop in the bucket. But to a guy living in Mississippi, he's not concerned. $500,000 is great. So we have to be able to use technology to make these laws more applicable to where we live and makes more common sense for all taxpayers around the country.
California Association of Realtors say that the Republican tax reform proposal would erode the attractiveness of buying a house in the Golden State. But economists pointed out on Thursday that these effects could also cause a dip in home prices that have skyrocketed. Do you think this could help normalize some prices on the higher end, Gordon?
Well, I don't. Once again, I don't like policy trying to normalize a free market. I think events do happen that naturally, make changes in the marketplace. But I hate to see government stepping in, making policy that's going to affect the marketplace, because it really, really throws free enterprise for a curve. And at the end, it's not the right thing for consumers.
Well, it was a policy when they enacted it. What's the difference?
Well, I mean, the policy when they enacted it, it wasn't a policy to
Well,
increase home ownership, but now if you're going
now
to
it's the
decrease
incentives.
home ownership, so it's going to de-incentivize something, which is always
De-incentivize, yes.
Let it work itself out. That's all I'm saying.
They're expecting to see about $3,000 or more dollars per person in California that they would end up paying more per year. I think that number's a little bit high. But there's also it's thrown on the table too about the property tax deduction as well could go away.
Yeah, and a matter of fact,
that
I was
one
listening,
right there really kind of.
I was listening to CNBC this morning. I think the governor to be in New Jersey was talking about that. He said, "Listen, New Jersey has some of the highest state taxes and taxes in the nation. For us to put a limit on that marketplace, it would kill the state of New Jersey if they put these changes in where you can't write off property taxes and you can't write off a certain amount of taxes, and that interest deduction is limited. It would actually put that state underwater, and that state is already struggling already, and that's one of the things he was talking about.
Well, talking about it going away at one point, Gordon, now they just talk about it being capped. Maybe that's the compromise that everybody kind of fears, and it is a compromise, and it might get accepted.
But these things are just on the table for conversation. I think when you're doing a tax cut and on a balance sheet, whatever you do to one side, you have to do it the other side to kind of equal the balance sheet.
I don't know. It sounds like the Republicans are going to want to push this through for a big win for Trump. It's just the way I
don't see
it.
That can't be a big win if you're punishing a certain segment of the economy. It can't be a big win. So a lot of these things are up there for conversation, for negotiation, and they put certain things to give and certain things to get. I think that's how it's going to pencil out at the end of the day.
We'll come back after this break. If you want to join the conversation, give us your input on what you think will happen if the mortgage deduction is capped. We'll be right back after this break and call the show 800-516-1220, 800-516-1220.
This is Money 2.0 on AM 1220 KDOW.
I'm going back to my roots. Another day, another door, another high, another low. Rock bottom.
Welcome back into the Real Estate Report. I'm Tony Mendez.
And I'm Gordon Hines.
Thanks for being with us today. You can always call the show 800-516-1220 or email the show tony@bayarealoansource.com. So it's kind of an interesting topic about the capping the mortgage interest deduction. And a lot of people are like, oh, what's Tony's opinion on it? I kind of follow Gordon's opinion. And for people who've heard me for years, Gordon, on the show, probably like, Tony wants to stay away from conflict and kind of to appeal to everybody. In this case, it's hard. Most of the people that are listening to us that are going to be out buying a house. Now, if your grandfather did, fantastic. But if you're buying a house, the people who are listening, most of these people, you're going to have to put a lot of money down in order to get that $500,000. Otherwise, you lose some of that deduction. But we've been experiencing that for years. People who get $200,000 or $300,000, $400,000 equity lines, right? They only get $100,000 of the interest deduction as opposed to the full amount. So maybe that's another reason why you consider looking at a refinance as opposed to an equity line if this doesn't get passed. But there are certainly some things to consider when buying a house nowadays, Gordon. Not just the payment. It's I had somebody the other day call and they say, we're going to get some tax deductions on this purchase. Does that mean now I can contact my employer and put more exemptions so I get more in my paycheck? And you probably can, but I might wait a year or so before I see how it starts playing out before you go to your employer and do that. But
that's something that I would refer back to the old rule we always use. Go talk to a professional, talk to your tax person, and find out, hey, how many exemptions now can I claim with my employer where I can bring home more money, have more disposable income now that I'm getting a raise, and now that I have a home deduction, all kinds of other kids deduction. And that's what we always push you back to your plan. But going back to something you just mentioned, there's a lot of private money out there. Like you and I were talking about a transaction today in which we had a loan arranged for a client, and the client called this morning and said his parents said, hey, listen, we'd like to fund your loan for you. I'll let you tell the story because it's your transaction.
Right, so they're looking for a loan, and the parents said, well, you know what? If you're going to get 4% or whatever on your interest rate, why don't you just go ahead and we'll give you the $300,000, and you go ahead and pay us the 4%. We're not making much on a CD right now. We're seeing a lot more of that in California, especially, and as equities go up around the United States.
And that's picked up a lot of slack in the marketplace. That's where a lot of young people are getting monies from to buy homes. Matter of fact, I got 3 of these transactions going right now, what we call gift equity transactions, in which parents, relatives are gifting the equity in their house, selling it to a relative at a discounted price, taking the equity that they have in the property and giving it to them as a down payment. People are buying houses with no money down as far as out-of-pocket expense because the money is coming from the equity in the property from the gift of the relative. So
and the relatives making out because they're getting, other than the fact that they have to pay income on the money that they're receiving, they're getting a good rate of return on that, in this case, $300,000. Fannie Mae, their consumer sentiment on housing has dropped a little bit from September when it hit an all-time high, according to their survey, where sellers thought it was a good time to sell and buyers thought it was a good time to buy. It's dropped about 8% and 6% respectively. Though the numbers are still higher than they are last year, many are calling this as the peak in the buyer-seller sentiments and kind of the perfect storm. So, Gordon, if it's the perfect storm where you have a lot of buyers saying it's a great time to buy and a lot of sellers saying it's a great time to sell, why don't we see inventories rising? Why aren't we seeing selling numbers increasing and prices are still rising as a result of all of this?
But what I am seeing, I've got my finger on the trigger with all the real estate people that I deal with. I am seeing a lot of price reductions. I'm seeing a lot of listings that come across the web on a daily basis. A lot of them are popping back up with, they don't call it price reductions, they call it now new price, which is a price reduction. So I'm seeing a lot of that. A lot of times there's an opportunity that everything happens in. There's a time where whatever you put on the market is going to sell for whatever you want. And there's also a time where, hey, you need to do a little bit more marketing and a little bit more time has to be invested into this particular circumstance in order to get what you're trying to accomplish. So right now, as we move close to the holiday period, a lot of times things get a little bit slow. January is a little bit slow, but then this thing peaks back up in the spring and back in the fall.
I think interest rates are definitely a big driver of the people who think it's a good time to buy. They also have part of the sentiment survey also talks about people's finances, and it's also at near an all-time high. It's down a little bit from September. So it's good to see that people are still looking at houses. I encourage people to not give up. Gordon, you're seeing more, I think is probably a more appropriate word, more price reductions or more new prices. I think that's a sign that, people are a little stressed out in the selling side. And I think as a buyer, you shouldn't give up. You should work with, the best professional realtor that you can and get as many offers as you can and put your best foot forward. And you'll get a house, and make sure you're well pre-approved in advance. Check your credit early. Those are the important things that we always recommend because you don't want something coming up in the last minute that could kill your deal. With that said, we'll come back after this break here on AM 1220 KDOW. I'm Tony Mendez. That's Gordon Hines. You can always visit our website, BayAreaLoanSource.com, or you can call the show 800-516-1220.
This is Money 2.0 on AM 1220 KDOW.
Welcome back into the Real Estate Report. I'm Tony Mendez.
And I'm Gordon Hines.
Thanks for being with us today.
Thank you for being with us every Thursday.
Every Thursday. 800-516-1220, 800-516-1220. And if you want to shoot us an email, Tony@BayAreaLoanSource.com or Gordon@BayAreaLoanSource.com. Gordon has an email. We have a couple emails to hit. Gordon has one. It's about seller financing, and somebody's going in, and that's where you go to a builder or a complex where they're selling homes, and they may or may not be finished, and you sign up and you start looking at seller financing. But you got to be aware of several things. What's happening with this person?
Well, this particular person, she says she went to a new home subdivision, looked at a couple of properties, found one she fell in love with, went to make an offer. She said that before she can make an offer, the builder insisted that she had to get pre-approved with their preferred lender, as she calls it.
Which is pretty standard.
She was upset about it. She said, I have a 800 credit score. I actually had a copy of my credit report with me. I already told them I was already pre-approved by another lender before I came in there, but they weren't having that, as she put it, and she felt they were trying to bully her into using their lender, and she wanted to know what her options were. She felt that had she not acquiesced and did what they were what they wanted to do, she would not have got her contract accepted. So she was just trying to figure out what's the legal obligation that they had. Did she have to do it, or she could?
It's illegal for them to. It's not illegal for them to require her to be pre-approved with their lender, but it's illegal for them to make her use their lender. So there may have been a reason, maybe a personal reason, why she didn't want to have her credit rerun and go through the whole process of getting pre-approved. She probably just went through a whole process and figured that she could walk into any kind of property, whether it's existing or new, and get just somebody, here's my pre-approval letter, for example. And maybe she didn't start out looking at new homes and then gravitated toward it and didn't know this about existing homes. But it is true. It's something that you kind of got to get used to. A lot of builders will also incentivize the use of that lender by giving you some credits. But when it's all said and done, that credit, nothing's free. All right, you might get some builder credits, maybe some upgrades for free. Those can be free. But as far as towards financing, rarely do we see something that's not built into the rate. And what we mean by that is somewhere the lender is building in money on their end and then turning and crediting it back to you. And you have to be careful about that, because in most cases, you're going to end up with a higher rate.
Well, I've seen this a few times, Tony. I've actually had run-ins with builders trying to compete with my client who walked into an open house. And once again, I think she's actually right. They were trying to bully her or strong-arm her into using their financing, because they feel if you use their financing, they're more in control of the transaction. But I think the law says if a qualified client is a qualified client. I think there's case law where she does not have to get pre-approved by their lender. If she produces a pre-approval, they have to take it. But a lot of times people are so intimidated, they feel they might lose the property if they don't acquiesce to the builder's rules. But you always, once again, check with your attorney, check with the Department of Real Estate, the BRE, and they can always tell you the legal obligation of what you can and can't, what builders can and can't make you do in order to get your contract approved with them.
And thanks for the email. You can always email us, Tony@BayAreaLoanSource.com or Gordon@BayAreaLoanSource.com. Interesting story about rates. Hong Kong homeowners face the prospect of a first rate hike since 2006. So what they do is they take your interest rate is going to be the it's called a running rate, and it's set at a cap, and then you have with a minus a margin, and then there's a bottom plus a margin, and you fall in between. What's happening is those bottoms and the tops are merging, so they're looking at a possible rate hike for the first time. Interesting to hear that that they're looking to follow what we're doing here in the United States as far as prime, and they're saying that prime rate, which we expect to go up here in December with the Fed's increase of their Fed's fund rate, is kind of changing the economy around the world, Gordon.
Well, I mean, we are the leading economic engine in the world. I think what we do, the other countries follow. I believe, not because I'm here in America, I think we have one of the better models actually when it comes to consumer finance options, different things you can and can't do when trying to buy a property or get a credit card.
We'll come back after this break here on AM 1220 KDOW. I'm Tony Mendez. That's Gordon Hines. You can email us, Tony or Gordon, at BayAreaLoanSource.com. We'll be right back.
This is Money 2.0 on AM 1220 KDOW.
Welcome back into the Real Estate Report. I'm Tony Mendez.
And I'm Gordon Hines.
Thanks for being with us today. Every Thursday. And thanks for the email. You can always shoot an email to us, Tony@BayAreaLoanSource.com. And I actually have a couple more. These are some quick ones. This had no name. Buying points. Lender asked us to pay 2 points for a 3.5% rate. Is that good? Well, the whole relationship about points and costs is what they call your payback period. So if you're going to pay points and your payment drops, let's say you're paying $5,000 in points and your payment drops $50, it takes you 100 months to pay that back. So do you want to wait 100 months to get your $5,000 back? Maybe, maybe not. Or let's say you're going to sell your house in 5 years. That doesn't make sense. So you have to look at the payback period. It generally, when rates are low, a lot more or less, we don't see a lot of people paying points, especially if they get like an ARM. What's your opinion on that?
Sometimes in a competitive environment we're in a high cost market, sometimes that you have to pay points just to be able to buy that rate down to
qualify,
to make you qualify. Yeah. So everything is based upon application. I mean, in today's marketplace, points aren't necessarily the norm anymore. Most in the new comp structure based on the Dodd-Frank rule is lender paid or borrower paid, meaning that the lender either compensates the broker or the financer for your points, or you have to pay them up front, which is called borrower paid. So there's a balance there. You just got to find what the best equilibrium is for you, and which is going to cost you the least amount going in and what you can qualify for. At the end of the day, it's your balance.
Yeah, we're kind of going back to our first story. We talked about Capital One and how they're closing their doors on their mortgage branches. Banks in general don't show you these options. They just go straight to the whole, what they call a lender paid option, low cost option. What they're not giving you there is the opportunity to pay more. Yes, to pay more, but you get that in return by having a lower payment or lower rate, which equals a lower payment. So again, you want to find somebody who can give you these options. We're working with somebody who's looking at a second home. He wants a 30-year fixed. And all of a sudden, he's looking at maybe around 4%. If you go to 3.625, it's going to cost you a little bit more, and it has this X amount of time and payback period. And I'm going to keep the property longer than that. It makes sense. I have the money, and he's going to move forward with it like that. So, and he'll save money in the long run. So you got to look at points in as far as time and payback period. Jose, seller by owner. This is a very common question. You have to be very careful as a seller by owner. What are the legal ramifications on this, Gordon? I know you've done this in the past.
Seller by owner? What does that mean?
Owner by seller. Seller by owner. You're selling your house. You are the agent.
For sale by owner.
For sale by owner.
Here's my
Sorry, I'm reading emails directly. They come to me.
Here's my patent answer. The only reason why a person wants to sell their home by themselves without the value of an agent is because they want to save on commission. So I say to you, if that is factual, why is 95 or 97% of all homes in America sold with a real estate agent? Because the real estate agent is the professional. Do not be penny wise and dollar foolish. The few pennies that you are going to save on commission is a lot less than the litigation costs that you're going to extend if you make a mistake on that list and don't disclose something, disclose something that's not factual. So the only reason why you see that in today's world because someone don't want to pay commission. There's
some stat out there, Gordon, and I know you know this, that using a realtor can you get like 5 or 10% more in selling price than you do if you do it on your own. But
you get maximum exposure. You get more exposure. There's a lot of things that the realtor does. The realtor brings us what they call accredited services. They give you they can refer you to a roofer, termite guy, all these kind of things that a package deal they can offer you that you might not necessarily done on your own.
Question was about the legal ramifications of you doing it on the own. You're carrying the whole weight of the California Association of Realtors, the National Association of Realtors, and all of their lobbyists and all of their attorneys. That's why you use them. Be very careful. Another email from Cruz. Does it make sense to take money out of my house in the Bay Area? I have about $200,000 in equity to buy a house in Vegas. I'm just going to read you this quick article. Las Vegas real estate in October. Sales are up 13% year over year. Inventory down 32%. Sales are up. Inventory's down. Prices are up.
Well, keep in mind, Tony, as I talked in the previous program, my daughter just transferred to UNLV. And I've been there twice in the last 60 days, and I told you the other day I'm bullish on Las Vegas. There's all from the time you hit the I-15, there's new houses going up everywhere. They're moving away from the brand of gambling. The professional teams are coming in. I'm bullish on Las Vegas. I see Las Vegas just being a mecca as far as appreciation for the next 3 to 5 years.
32% down in inventory from 1 year ago, which is crazy.
A lot of people are moving there.
Sales are up 13%, 16% for condos and townhouses. For some reason they don't have the year over year, but the last time I looked, I think it was about 13% as well year over year home prices. So whether or not you take it out of your house, I like leveraging. Rents are also going up in Vegas. If you can stay within your means in your house, you can borrow at a cheaper rate and maybe put more money down and get more cash flow. Then you're paying more taxes. So it's going to be a balance. And it's just a simple running numbers and which one makes sense for you. And it may come down to qualifying. Do you need to leverage more on the property in Vegas or any rental property for that matter so that you can have more of that rent offsetting that debt as opposed to putting it on yourself in your primary residence, which doesn't have a rent to cover it as your income. So again, it's all about sitting down with somebody to run the numbers. But thanks for the emails. You can always email the show, Tony@BayAreaLoanSource.com or Gordon@BayAreaLoanSource.com. 30-year fixed interest rates at 3.9%, expecting to go up a little bit next week. 15-year at 3.24%. What do you think of the 15-year? For someone who has been in their mortgage, let's say they've had a 30-year fix since, let's go back to 2005, and they haven't refinanced it. They had a decent rate. They're 12 years into it. And maybe they, you know what, if they go to 15 years, so they got 18 years left, they go to a 15-year, they keep the same interest rate or even lower, and they shave off 3 years of payments. All of a sudden, it's starting to make sense.
Man, everything you're asking me today, I'm bullish on. I'm bullish on 15-year loans. I've been bullish on 15-year loans. I tell clients all the time, anytime you can afford a 15-year loan, even if it's a stretch, it's well worth it. For one, an equity building position. 1, 2, less interest paid. Houses paid off a lot faster. So
It's not 1/3 lower.
Yes, so it's a beneficial loan. The longer the term, of course, the more interest you're going to pay. But in rising housing markets, I understand that the 30 years, and now we're seeing the 40-year come back because we need those longer terms to be able to make those payments affordable to keep people being able to qualify.
When we come back after the break, we're going to touch base on jumbo loans. Most people in the Bay Area are looking at jumbo loans. If they're doing median home pricing in the Bay Area with 20% down, they're going to be getting a jumbo loan. What are some of the things you want to look at and how to get the best rates with a jumbo loan? We'll come back after this break. I'm Tony Mendez. That's Gordon Hines. You call the show 800-516-1220, 800-516-1220. We'll be right back.
This is Money 2.0 on AM 1220 KDOW.
Come with me now. Come with me now.
Welcome back into the Real Estate Report. I'm Tony Mendez.
And I'm Gordon Hines.
Thanks for being with us this hour. What is today, November 9th?
November 9th.
November 9th. Wow, this
Clock went back
time is
last
clocking,
week.
right?
Clock went back last week. It's dark outside right now.
Jumbo availability in the market has been improving month after month since 2011, according to the Mortgage Credit Availability Index, which is measured by how easy it is to get a loan or how hard it is to get a loan. It depends on which way you look at it by the Mortgage Bankers Association. And the one thing not only is it getting easier, we're also seeing interest rates dropping, and the margin between a conforming 30-year fix and a jumbo 30-year fix is almost nothing today. But in order to get that low interest rate and to access that jumbo loan, the one and most important thing, Gordon, credit score. They are so highly tuned to what your credit score is. For example, the difference between a 680 score, which you can get a jumbo loan with a 680 score, and a 780 score can be as much as a whole point. And if you're looking at a jumbo loan, that is a $300-$400 difference in payment just on that 1% difference.
Well, that's because, as we always talk, it's called risk-based pricing. So the higher the risk, the more it's going to cost you. So if you got two applicants looking to buy a property with 20% down, and we have a notebook that we're looking at, and it's 20%. One have a credit score of 740, the other have a credit score of 680. The guy with the 680 is going to have to pay a premium to get that rate because he has to actually buy that rate because of the way how the loans are priced through the Fannie Mae and Freddie Mac matrix.
Second thing you have to pay attention to when getting a jumbo loan is your reserves. Not only would you need equity or down payment, just depending on if you're doing a refinance or a purchase, you also need to have, in some cases, 6 months, 9 months, 12 months, 18 months in reserve. So they want to see that you have money left over. Again, the harder the loan, the lower the rate. Let's use that formula as we talk about these types of what they call A-paper loans. So you want to have some reserves. You can't use all of your money in a jumbo loan, unfortunately. But there are other products, and you could stray off to some sort of portfolio, which they call like not private lending, but it's a portfolio loan held by the investor, and they use jumbo guidelines for that. But you really want to. Your rate's going to suffer from that.
Well, the good thing is right now is we always talk that, in my opinion, rates doesn't push the market, programs do. And right now we are enjoying the flexibility and the comfort of
having
many,
kind of
many
both right now.
products coming on the marketplace. And the more products come on the marketplace, there's a situation for everybody where a few years ago, after the big crash in 2011, 2012, there was only one horse in the race. Now you have many different horses to choose from, and it's which horse is going to take you to the finish line the fastest. So sometimes we have to use two different loans to get to a certain situation. You had a catastrophic financial event. You might not be able to get that 30-year fix at 4% today because you got low credit score, bankruptcy, foreclosure, deed in lieu, whatever. So you might have to wait, get into a private loan or get into a non-QM or investor portfolio loan, and then year, 2 years, 3 years from now refinancing
That exit
long-term
strategy,
fix.
yeah.
So there's many different products in the marketplace, and that's what we're here for. That's what we preach. That's what we like to teach. That's like when people call us. That's why people call us. They call us to get advice. Hey, what is the best situation for me under my circumstance?
Yes, you can always email the scenarios to either Gordon or I, Tony at BayAreaLoanSource.com or Gordon at BayAreaLoanSource.com. We truly do enjoy getting all the emails in response for from the radio show and from the other things that we do. I think there's a seminar coming up next week, I believe. Rob Black seminar down in Los Gatos. Gatos. Sorry, I'll say it correctly for those who get offended when people say Gatos. Okay. Which I believe it actually is pronounced Gatos, but I don't think that the city wants to be called the Cats. Or
well, this year in history, you got to get this in before before we run out of time. Today, believe it or not, the first post office was opened up to there.
San Francisco,
San Francisco, I believe, first post office. And believe it or not, the post office is one of the best managed offices in our government situation. They've made strides over years, and they've really come to fruition to deliver the mail on a timely basis.
Well, you can always email us, Tony at BayAreaLoanSource.com or Gordon at BayAreaLoanSource.com. We'll come back after this next week, that is. You can always go to our website,